Hi, I'm Will Jarvis.
And I'm Will's dad.
We both love and are fascinated by stories.
Stories about people.
Stories about places.
And stories about events.
Our stories give shape and form to life.
They give texture, color, and rhythm to the blank canvas that every new day presents to us.
And they do that by informing us of our past as a directional marker for our future.
Okay, Will, it's narrative time. Tell me a story. Welcome to Narratives. This is Will's dad.
This is Will.
It's good to see you. It's been a while since we've sat down.
Has been a bit.
Yeah, and we've got an interesting subject today.
Yes.
A bit ambitious.
Yes, it's a paper by the San Francisco Federal Reserve Bank called The Rate of Return of Everything.
The rate of return of everything. Not just some things, not the most important things, but everything.
Everything. That's right.
And it's also got the Board of Governors of the Federal Reserve System on their names on it too.
Yeah, it does.
So tell us this. Tell us what the Federal Reserve is.
Federal Reserve is interestingly, it's a private bank, but it's set up to maintain the stability of the U.S. economy, maintain full employment, prevent runaway inflation and bank runs. So it was actually its chairman is appointed by the president, confirmed by the Senate, I want to say, and it's like a quasi federal government institution. It's supposed to be independent, and it's supposed to just make sure things run well in the economy.
And so there's four major functions of the Federal Reserve. The first one is it controls the money supply. That sounds important.
That is important, yes. So that's important because the supply of money affects all kinds of different things. So during the Great Depression, there's a big money supply shock. So there was actually, this is my view a little bit, but there's a great economist called Scott Sumner at the University of Wisconsin-Madison that talks about this a lot. There's a big deflationary shock, and they should have actually injected more liquidity into the economy, but they didn't, and the depression ended up just as bad as it was. So maintaining the money supply and making sure there's enough money flowing around is really important for a functioning economy.
So another obstacle the Federal Reserve wrestled with was the downturn in 2007, 2008.
That's right.
And so they must have had an idea that they need to inject liquidity into the market. Did they?
Yeah. So they should have done it faster, and they didn't do it aggressively enough. Actually, in 2008, and that actually contributed to a lot of the problems we had.
Yeah, and if you listen to, because the next big obstacle would have been the pandemic, and when you listen to them on the podcast and in the news, where representatives from Federal Reserve appeared, they'll say that they realized they needed not only to inject money, they need to inject it fast. Speed was a problem 2007, 2008.
Yeah, hilariously, they're kind of solving for the right crisis. So I think the response was perfect for 2008 crisis. The response towards the pandemic would have been perfect in 2007, 2008 in terms of speed and volume and size. I think hilariously, it probably wasn't exactly what we needed here, but they're doing what they can. In reality, all the money we threw at the problem, and this is more on the fiscal side, not on the Fed side, which is monetary policy. On the fiscal side, all the money should have gone towards containing the virus and getting rid of that, because there wasn't a problem in the real economy other than the fact that there's this crazy virus running around.
It does seem like the speed thing was, if it wasn't perfectly done, it was probably better done, because they realized that you couldn't vet everyone fast enough and decide who need the money. You just need to get the money out there to as many people as you can, and then try to sort out some of the other problems later.
So yeah, that's on the fiscal side towards the big stimulus package. But that's different. That's a little bit different than what the Fed did. That's not the Fed. That's the federal government, spending wise. They did get money out the door, although the Fed did a ton of emergency lending overnight lending to make sure everyone had liquidity when things, I remember the market sitting on my couch in Durham. It was kind of cold, and the market's going handle down, handle down, handle down, which is like, whenever the market goes down 5%, they like shut it off a little bit. And it's just like, oh no, we're shutting it off again and again and again. Like, whoops. Yeah. So they were quick to act. Kind of like Tony Montana. I think I tweeted out, this is Jerome Powell's the head of the Fed, Jay Powell, and Fed chairman, and he was kind of like going Tony Montana on top of the pile of coke at the end of Scarface with all the liquidity injections. This is like everything he had, kind of going nuts.
Okay, another function, one of the major functions of the Fed is to regulate financial institutions.
Yeah, they do that too.
They give them rules.
Yes.
Try to make them behave.
Yep.
Follow the rules. They also manage check clearing procedures.
That's right.
That's interesting in itself. Yep. Another big banking function. And they supervise the FDIC.
That's right.
For commercial banks.
Yes, that's the bank run prevention kind of. So if you have less than $250,000 in a bank, it's backed by the Federal Direct Insurance. Or what is it?
Corporation.
Deposit Insurance.
Federal Deposit. I would have to look that up.
Yeah, okay, I can't quite remember the acronym, but
you see it on all the stickers when they're all on the doors on the sticker on the banks, and that's what protects your money up to $250,000 in your account.
Yeah. So the federal government will guarantee the deposit up to that amount, which is, not all banks have that across the world. It's important to remember.
Yeah. Okay.
That's to prevent in panics. So, we both personally know someone who showed up at a bank and withdrew all their cash during 2008, and like it's to prevent that from happening. The Central Bank of the United States, that's what the Federal Reserve System is. It's the Central Bank of the United States. Yes.
So that in itself should tell us how important and big it is.
Yes.
Right? So that's who wrote this paper or this treatise on the rate of return of everything.
Yep. It's a paper. It's quite interesting. It details what returns over time that each asset class is average. So they covered T-bills, is that correct? Treasury bills.
Yes,
bills,
that's right.
And then bonds, real estate, and equities.
Equities are
pieces of companies.
Stocks, I think.
Stocks. Pieces of companies.
Stocks.
So, yeah.
And the scope of this is they studied 16 advanced economies from 1870 to 2015, just about 150 years.
That's right. So it's a limited data set of what they could kind of get their hands on. Always important to remember when setting off on these ventures, there's limitations of what you can actually look at and what's available. It was like Australia, a bunch of other advanced OECD countries, I'd say, from 1870 to today.
What are OEDC countries?
Advanced developed countries, essentially.
Okay. So it covered those four classes. And surprising to me, the one that they had the most trouble digging out was information historically about housing. And the other thing that surprised me is that housing is about 50% of the national wealth in a typical economy. That really surprised me.
Yeah, it's interesting. I guess the habitats where people live make up quite a bit of economic activity in general.
Yeah, and it tells you a lot, like when there's a housing crisis, why the whole economy in the world shakes.
Yeah, on the margin, it can really matter.
Yeah, that's really important. Okay. Now, you want to talk a little bit, because this comes up. One of the things they really studied intently was secular stagnation. You want to talk about secular stagnation?
Sure. So secular stagnation. Secular stagnation is the idea that essentially since 1970 or so, there's a great website, I'll have to put a link in the description, called What Happened in 1970. And it's all about how in 1970 growth rates started slowing down, and we've been stuck in kind of this funk of low growth for a very long time. There's a number of reasons why this may be happening. I've got my own thoughts. A bunch of people have their own thoughts, and whether or not it's a fixable problem is interesting. I think it's always good to look at Western Europe as kind of maybe 20 years ahead of where we are in certain aspects along these lines. And I think it's important because economic growth has really slowed down over the past, 40, 50 years. And that has direct consequences on our political life, our day-to-day life, how we approach the world in ways that I think people really don't realize. So, for example, on the political front, there's some sense in which things have gotten really weird, partisan, crazy, going all the time now, right? Like, so you see like this crazy partisanship, everybody's at each other's throats. And I think this is actually a symptom, not a cause. I'm a big believer on the fact that this is a symptom, not a cause. A lot of people, even academics, will say, well, this is like a cause, not a symptom. And I think that's like this huge mistake. Like, it doesn't make logical sense to me. Although I do have this bias. I think people are like kind of trying to do the best they can and are just get incentivized into these weird things. There are bad people, but that's on the margin. So why do I think this is a symptom of low growth? So I think democracies, especially a huge democracy like the United States, we're the biggest democracy, I would say, correct?
Probably.
Trying to think, yeah. You can always kind of bunch Europe together now, but it's kind of a different thing. But even then, I think they'd be slightly smaller. So with 350 million people, all kinds of different people from different places, America is not a very homogeneous place compared to most countries, right? Like, so most countries are small in terms of numbers. They usually have one ethnic group. So like in Denmark, most people are Danes, things like that. They tend to like more of the same things. America is like super varied. Like, you go to New Orleans and then you go to like, Raleigh, and they feel like different places. All this is less true in big cities nowadays, but there's a lot more variation in people, preferences, attitudes, etc. So why is that important? Well, if you're trying to run this country and keep everybody together, democracies really work well if the pie is growing. So if the pie is growing each year, we can all sit down at the table and we can all split it up in different ways, and everybody gets more than last year. And even though sometimes it might not be exactly equal, everybody's getting more than last year, so we're kind of happy. As the pie gets bigger more slowly, there's less to divide up amongst us, and that, to me, is what's really going on, is that there's less to divide up, and so people are more desperate to kind of claim their share of the pie.
So that's one of the things the paper they looked at, was that the growth rate of the economy is relative to the rate of return of capital. And the reason that that's important is because it affects wealth, it affects income, and it affects inequality. So that growth rate and rate of return, when we say that this is really important, the rate of return of everything, it's not only important because it affects somebody that wants to make some money on some capital they have. It affects people because if they're looking at their retirements, they were saving for that, or if they are retired, they can't make money on their capital so they can support themselves.
Yes, although super important distinction here. There's a difference between the rate of return of these asset classes and the rate of return, like the growth rate of the real economy. These are two separate things. And so also the paper talks about the rate of return of these asset classes may be higher than like the rate of return to labor. So capital is like, let's just describe capital quickly. So capital is anything that you know makes you money. So land, there's human capital. If you have a machine that spits out apples you can sell, that's capital. And then labor is like doing things yourself, right? Like, so going out and shoveling would be labor. This is the theme of a big book that came out in 2015, 2016, somewhere along then, called Capital, and Capital in the 21st Century, I believe. Was it Capital in the 20th? It may just be Capital. I can't quite remember. By Piketty. I'm going to butcher the French here. He's a French economist, and his idea was that the returns on capital are higher than the returns on labor, and maybe this is getting worse. And that's a big problem for inequality. So the people that own capital keep getting richer, and the people that just have their labor are kind of like stuck or stagnant or maybe heading backwards. And you see this in like real wage growth over the past, since 1970, it's fairly stagnant. And, you know, inflation's like a weird metric, right? So if you lump like TVs together with essential goods like healthcare and education, you could like draw this trend line. You know, TVs are getting like super cheap. They're getting a lot cheaper. Cars are like maybe getting a little bit cheaper. But then the essential goods people need, like, so education, which is a proxy for mobility in our society, it's getting much more expensive, and healthcare is getting much more expensive as well, keeping people alive. So when you look at those two things, it kind of paints a bit of a grim picture at the end of the day. So that's kind of the distinction between, you know, growth rate in the real economy, and then the rate of return to these capital, to capital, which we're talking about.
So
and these different asset classes.
What is the impact on rate of return of capital for inequality? I mean, does it mean that the top gets pushed forward faster than the bottom? Is that where the increases inequality?
Yes. So if the rate of return of capital is higher on average, that will make the rich richer and make inequality worse.
Now, if that's true, does it mean that the relative position of the bottom sinks lower, or it just doesn't improve as quickly?
So, yeah, it's tough. There's always trade-offs. That's the important thing to remember. So there's a great thought experiment by Robert Nozick, and it's a Wilt Chamberlain. It's like called the Wilt Chamberlain example, I think, or something. But it involves Wilt Chamberlain. So you imagine we had like a group of 500 people. So who's your favorite basketball player? We'll sub in Wilt Chamberlain.
Michael Jordan.
So Michael Jordan. And Michael Jordan is in the audience. And we all want to see Michael Jordan play. But Michael Jordan, he's really tired of playing basketball, doesn't really want to do it. So we all chip in, you know, $1. And so there's 100 of us. So Michael Jordan gets $99 to let's say we all had $1. Just like this thought experiment, we all had $1, even Michael. So Michael gets $99. Now he's got $100. And he goes plays basketball, and we're all like, whoa, we get to see it, and it's like so excited. He dunks the basketball, sticks his tongue out. It's awesome. He's got all this money now, and it's vastly unequal, right? Because everyone else has no money. But we all get this like utility from seeing Michael Jordan play basketball, and we wanted it because we voluntarily gave him the $1. We didn't have to do it. So, you know, voluntary exchange can create unequal outcomes, if that makes sense, in different ways, even though we're all better off, which is important to think about. There's also this trade-off between the size of the pie and how much we grow the pie and how equal the pie is. So you can get more growth, and but the people at the top will be much richer than the people at the bottom. Even though you can have this, it's called something being Pareto optimal. So Pareto optimal means we can both gain. Like, so we do a transaction and we both gain, which is important. So like economists love Pareto outcomes because we both gain, even though you might gain a lot more than I do. So it could be. So it's probably the case that you can have higher growth rates, and but the trade-off is that it's more unequal. Now, the people at the bottom are absolutely much better well off, and some of this is like a preference, pure preference thing. So I like to ask this question: would you rather be, a middle class person today in America, or would you rather be Cornelius Vanderbilt?
I would rather be a middle class American today.
So yeah, you can tell a lot about how people like think about inequality and how much they value it, how they answer that question. So I would like to be a middle class person because I think you're much better off in terms of just raw health care. Like entertainment, I think is a lot better. I think some people value positional, like this is just their inbuilt preference. They value positional status a lot more than like raw, and like that probably pans out on like political beliefs too, than raw like well-being. So I think like being a middle class person would be much more enjoyable than being Cornelius Vanderbilt and like not having like ibuprofen and crap like that. Like, like these things are worth a lot to me. But some people really value status and positional status and would much rather be Cornelius Vanderbilt. And I think people that would rather be Vanderbilt and have the Biltmore estate and like all this stuff tend to be more concerned about the inequality question. Because, all things being equal, not everybody can be Cornelius Vanderbilt, but we can get a lot more people to the middle class standard of living, theoretically than so, what's achievable. And my thought is, if you answer you'd rather be a middle class person, well, that's like, man, then this growth is good and the inequality we've experienced, because Cornelius Vanderbilt, it was much less unequal then. Like he was a rich person, but he was not like Bill Gates or Warren Buffett rich, relatively. Like people are much richer now. Jeff Bezos, like on paper, his wealth is so much more than Cornelius Vanderbilt could ever dream about. So like there's these trade-offs, right? So there's trade-offs between inequality and growth. I tend to think growth is much more important because one, I don't think our democracy really works without it. Two, I think there's all these other gains you get, such as ibuprofen. Like ibuprofen hadn't been invented. Like it's a huge benefit to me, and it did create some unequal outcomes for the guy who invented it, but we did end up better off in the long run.
So what you're telling me is the more important question seems to be growth and inequality.
Well, I personally believe that, but I could see how someone would be more concerned about inequality. Yeah. Because, people that care more about positional status than I do would be more concerned about inequality.
We probably make the point when we say that, we don't mean that we're unconcerned with the people at the bottom. Those are the ones I actually think are the most important consideration, because everybody else can kind of fend for themselves. You can worry about your position and whether you're driving a Chevrolet or Mercedes Benz. I'm really worried about the guy that might be riding, not even have a bicycle.
It's very Rawlsian of you.
Explain that.
So it's very Rawlsian. So John Rawls had this thought experiment called the veil of ignorance. So the idea behind the veil of ignorance was that whenever you evaluate like a certain policy, you're trying to think about what we should do, you should always imagine that you're go behind the quote unquote veil of ignorance and imagine you are the least well-off person in society and evaluate it like that. So a lot of people think like this, and the answer would be, what matters more? Is it the absolute position or is it the relative position? There's absolute or relative. So like relatively to like the poorest person today compared to Jeff Bezos is much farther off than, probably the poorest person was when Cornelius Vanderbilt was alive, and Cornelius Vanderbilt or, JP Morgan, someone like that. However, the poorest person, or let's say the lowest quartile, it's easier to think about, is probably significantly better off than, in absolute terms, than the person in 1900. So just trade-offs. Again, it's like trade-offs between these two. I tend to think, the absolute position is much more important, but there are a lot of people who who care a lot more about it. I think I like to think about it like this, and I think this may help you grok something. So let's say you and I are walking down the street. We both spot a $20 bill at the same time. I pick it up. I give you 1 cent. I keep $19.99. How would you feel?
If you saw it first, I would feel like that's just
We
yours.
both saw it at the same time.
If we saw it at the same time, well, then I think you ought to split it with me. If
Exactly.
everything being equal,
Everything being equal.
and
what
nothing
would you
ever
think?
is, but
How would you feel if I took $19.99 and gave you a cent?
then that would feel like that's not fair.
Exactly. Even though you're better off.
Yes,
You are in absolute terms better off. So I think that this is important in understanding people's psychology about why they are concerned about it, is because it's that example right there. It's like, if I give you a penny, yes, you are better off, but it's taken as a slight because there's kind of like an almost internal kind of fairness clock, and it's inbuilt to they've done experiments with rhesus monkeys with this, and you give them one monkey 1 grape and another monkey 20 grapes, and he's like, what the heck are you doing? So this is somehow super inbuilt to primate psychology, and is left over, and so it's some kind of moral what's the word? It's moral foundation, like Jonathan Haidt would say. It's kind of a moral foundation.
Okay. Now that we've explored that, explore this. So I can remember in the 60s and 70s, generally, there was one person in the household that worked, one that stayed home in families, and one that stayed home with children, and you had one car, and you had a little ranch-style house, and that's what middle class was. And and that's one of my sort of global views of life, is that if everybody had that, then things would be just peachy.
Yeah.
Except for unless a $20 bill falls on the floor.
Yeah, then we got problems.
So now things have changed.
Yes.
Now we have 2 people working.
Yes.
And we have 2 cars in the garage, and you can't have a little ranch anymore. You got bigger house.
Yeah.
And so we've got many more people working.
Yes.
And what's been the impact of that with growth?
Okay, so how to attack this? Important things to remember. Do you know what hedonic adaptation is?
I do not.
So imagine so I started coming in, and every day I brought you this delicious cappuccino from Starbucks. It's amazing. If suddenly I was like, well, you can't have a cappuccino anymore, so the first time you get a lot of utility from them, oh, this is so good, and you get less and less and less and less and less going on. So if I gave you instant coffee from the little instant coffee pack, you'd be like, man, this is gross. I'm used to, this really sucks. But if you had no coffee and I gave you the instant coffee packet, you're like, wow, this is, I'm coffee. I like coffee. I'm amped up, good to go. So hedonic adaptation is the fact that and it's always important to keep in mind in your own life, is that whenever you step up the hedonic ladder to a nicer car or something like that, it's the effects are short run, and then essentially they get built in soon after that. So I think a lot of what's been going on, why people have this sense things are worse, is because expectations are lower, if that makes sense. So instead of thinking you'll be better off than your parents, you're going to be the same or maybe worse off. And that is a big blow, because, you're going back down the ladder, if that makes sense. And millennials, we have a lot less money on average than boomers did at our age. It's just this real fact.
Is a large portion of that due to growth?
Why is that the case?
Or what is the impact of growth on that?
So the impact of growth. So in real terms, there hasn't been very much growth. That's the answer to that. It's there hasn't been real growth, very much real growth, and that has caused that to be a problem. There's more people and shrinking opportunities, and you can feel this just almost in the ether on college campuses. It's it's almost desperate, the partying and drinking, because there's this knowledge that there's just less opportunity, and fighting more hard to just kind of stay in place.
One of the things that they come across in the paper is that the natural rate of interest is decreased over the last 40 years and near zero.
Yeah, so I don't think this is a new trend. There's like a rough trend line. I saw a graph once that showed the interest rates since like Old Testament times, like pre-Jesus times, and it was heading south since then. And it's like a messy graph, right? It's going up and down, up and down, up and down, like a electrocardiogram. But it is heading south. And the answer is why is that? And Karl Marx had this idea that the capitalists are done once interest rates head below zero, or head to zero, and that's where we are now. It's like essentially a zero interest rate, negative interest rate environment in Western Europe. I think his critique is correct in maybe some sense. I don't think it's like destiny, but I do think it's correct in the sense that it is an indication that people have less ideas. Like there's less competition for money for projects to like do things. Like people just have less ideas in general, less good ideas, and they're less likely to take action to do things and
is there
things.
More competition or less competition for good ideas since we have fewer?
I think there's very few good ideas.
So there's more competition for them.
Yes, you can see this now, especially in like the venture capital industry. This is a shift over the past 6 years. Now everyone wants to work in venture capital, and they're all competing for less and less good opportunities. Where it seems like the real like $20 bills and the sidewalkers is building good companies. Like there's just no one building good companies and that's emblematic of. And the question is like, these are a bunch of smart people. So do they realize it's just too hard now? Is it just too painful compared to watching Game of Thrones on Netflix or whatever? I don't know, but it's a real effect, and it's worth thinking about.
So do you think that it's harder to know how to do something like start a company? Like you that's one of the things you did, is you've been involved with a startup. Is it harder to do that because you just don't know how, or is it just harder to have ideas? What's causing that?
I think it's harder to have good ideas. I think there's more knowledge about. It's like I think the fact that thinking about startups is like in the culture, and like entrepreneurship is in the culture, or these ideas is actually like a red flag that it's not really happening very much. Like, so it used to just be in the ether, like it just happened. People would always be starting things, and it's the lowest rate of new company formation. Like every year it keeps ticking off, like there's less and less and less. And I think like there's this sense it's too difficult, or there's no good ideas, or all the frontiers have been used up. But, we can imagine all kinds of areas where this is like, all kinds of good ideas we could be doing, but we're just not.
I think one of the things that's true is risk plays into this. Like you can think, I'll go to college, because the statistics show that if you go to college, you have over the course of a lifetime higher earnings. And so this is sort of my golden ticket. And so what I just need to do is go work hard and study hard, and I'll get this degree, and then I'll be successful. Whereas if you sort of strike out on your own and start something, then there's greater risk, because for one thing, you just don't show up and go to class every day. You got to create it.
Yes, I do think it's maybe something like, okay, so what's the alternative? So I think in a world with a lot of opportunity, the risk for starting new things is lower, because like the alternatives, well, I can just go find something pretty easily, right? I can go work at, I don't know, the factory and make a solid living if things don't work out. I think now the real risk is slipping out of the middle class. And I think that's what you feel in college, is like this really sense of foreboding, like, you're like on the edge, like this understanding you're on the edge of not making it, and slipping down the mobility ladder is very scary for people. And if things don't work out, the risk is much more existential than it used to be.
Explain that.
So like it used to be, if you're a grand vision for the world, making the world future different, didn't work out, your alternative was, well, you could definitely go get a job immediately. That was dignified and was high paying. Now I think it's like if you didn't follow that track and didn't make it, it's like you're off the wagon, buddy. You better, like, you're done. Does that make sense? Like you will, your mobility, social mobility will suffer.
So now explore. It seems that in the relatively recent past, it became a popular idea that if you were involved with STEM, like you were sort of like more golden than if you were in the humanities track, in which case you would be an art historian and you would have no future.
Yes. So I think, so the grand illusion I would say here is that, that STEM is the savior, right? In reality, I know I personally benefited from the fact that, like, I knew the humanities would not, there's no salvation, which is somehow very valuable lesson early, seeing the world as it really is. Whereas STEM, like, there's still this hubris that, like, oh, like, it's salvation, right? You just do it and you're fine. But the truth is, like, no, you still have to work just as hard, maybe slightly less hard. It's unclear, but that is really important to understand. Like, if you look at the engineering fields, like, other than computer science and, like, probably oil and gas, petroleum engineering, there hasn't been a good engineering field to go into. Maybe electrical, I don't know. But in the past, like, 20 years, like, you wouldn't make any money going anywhere else. And that's a good example that, it's like there's just fewer and fewer opportunities, and that makes things difficult for everyone.
So if you do take the gambit, assume the risk, think of Elon Musk, and he's willing to risk it all. He astounds me. Like, he'll just invest everything because he feels like it's a good idea.
Yeah.
A guy with good ideas. What is it about? Is that the difference? Is it that people that are willing to risk? I mean, you went in with a startup, and there was a good chance of failure, maybe a dominating chance of failure. And what did you learn about thus having survived a lot of that? The company survived a lot of that, and it seems to be tracking well. What did you learn about? Was it smooth all the way, and you just sort of go in and have your coffee in the morning and work along and head home at 5, or it's different than that?
Yeah. So a coworker, friend, and I think we talked about this in a previous episode. We counted 12 independent times where we thought there's a greater than 75% chance probability we would not be there the next week. Like, we would not be around. I really hesitate to give advice. I think you should generally be quite skeptical of advice unless it's someone who's, like, really close to you. And even then, and this is a piece of advice, right? So it's like, yeah, take it as it will, right? But you should generally be skeptical of advice. I think there's, like, Elon can do that. There's a great book, 0 to 1, it's called Notes on Startups. I highly recommend it to anyone. But there's, like, this reading of 0 to 1. It's like, wow, like, I really should not go into startups. Like, that is probably the correct reading of 0 to 1. It's like, really, like, I should not start anything. Which is, like, counterintuitive, right? But, like, when you're talking to people like that, who should be starting these things? Like, well, it's people like at Google. It's like the engineer at Google who's making $500,000 a year and sitting around on the beanbag chair eating M&Ms. Like, that's who should be doing these things, right? These super capable people who are not doing it otherwise. You need to understand, like, where you are and, like, does your life have kind of product market fit with startups and things like that, because it's not for everybody, and people take that the wrong way as it's something, like, attractive and sexy and, like, cool to do, and, like, yes, but you need to understand, like, it's a pretty serious undertaking, and if you're going to go for it, you need to understand all of it.
And
Critically evaluate.
All of life is a pretty serious undertaking.
That's
so
true.
It's being able to measure things and quantify them and say, okay, I'm going to give this a whirl, and I'm going to invest this, whether it's time or money or whatever it is, and and try it.
Yep.
And I think then you've got to be able to risk not succeeding. And if it doesn't succeed, what are you going to do? You have to have some plans about that. But
Yeah.
I'm going to circle back around and pick back up on equity, housing, bonds, and bills. And so what the rate of return of everything said was that equities and housing return more than anything else.
That's right.
And by a significant margin, like 10 to 1 or 5 to 1 or something like that.
That's right. That's right. And for the SEC, go after Elon. We're not. This is an investment advice. Like, you got bigger fish to fry. So do your own research. I want to. Yeah. So always important to remember. There's risk and risk and reward, and people are fairly rational. So especially when evaluating things like this. So equities. Where did you want me to go with that?
Well, I think risk and reward that's sort of that's a big part of the entire question. So if we start with housing, what I would say about housing, real estate, is that the risk is, you can't diversify well. Like the three primary considerations in real estate, it's one of those sort of truisms, is location, location, location.
Right.
Right. So you're going to pick something, but you can only, it's going to be hard to pick more than one.
That's right.
Initially, and then maybe you can grow in, and maybe over time you could grow into a number of them. But even when you grow into a number of them, they're likely to be in the same community. So,
that's right.
So gaining diversity is very difficult with housing and real estate.
Yeah, and just talking about my personal bias, I tend to like equities more. I believe equities. They have, so real estate does outperform. Like in this paper, this is what they talk about. Real estate outperforms equities by a small margin. Although there's this trade-off where transaction costs are much higher for houses. So you can just go buy equities super, like for Vanguard, you pay 0.01%, fees a year to buy and have them manage, most of their index funds. And then you look at houses and you're like, well, I can buy one house at a time in one location, and I have to pay property taxes and upkeep and maintenance. And, it is interesting to me that this paper found that result, because what I've always heard and seen is that, housing really doesn't outperform, real estate and housing, kind of two separate things, but doesn't outperform inflation. And I think there is the truth that there's land, that's one thing, and then your house, which is a wearing good, that's important. It's like buying a car. A car and a house are much more similar than people would like to understand, like to believe. As a consumption good, it's something you consume over the life cycle. So that's the big dirty secret about a lot of houses. They're meant to last like 30 years till the end of a 30-year mortgage, and they kind of fall apart, right? I don't know, like not like by design, but that's just how they're built. And I think in that sense, yeah, it's more a commodity, but real estate is a bit different in that it does seem to perform similar to equities, or maybe a bit better.
And that's one of the points we should raise. Is we said a lot of this is a measure of risk versus reward, and the big hedge is diversification with risk. So if you can own all the houses in your state, or maybe in the nation, or a portion of them, even a very small portion, then you'd be well diversified. And the chances that you would do well would be greatly increased, because if there's an earthquake somewhere, there's a fire, or something happened to one house, and that's just a very small part of your holdings, right? Yep. But if it happens to be the house you own, it's a disastrous catastrophe. Problem. It's a big problem. So diversification is really important, and that leads us directly into talking about equities, which you sort of brushed up against, and that it's really now because of Bogle, really
Jack
easy.
Bogle.
And you might talk about Jack Bogle just a little bit historically, to diversify.
Yeah. Yeah. So it is. It's much easier to diversify in equities. Like you can buy, there's like a fund, VT, which is Vanguard Total World Stock Index. And you can buy for $75, you can buy a tiny sliver of every single publicly traded company that an American essentially has access to. It's not quite the case, but it's pretty close. And so, wow, that's pretty easy. It's like $75 and go crazy. Housing, there are similar equivalents called REITs, which are like real estate investment trusts, but they don't have every house in America and they don't have every house in the world. And it's like usually a select in like the Southeast or something. And that could be okay, but it's definitely not as easy. And there's also more management fees because it's more difficult to administer than housing.
And was that Bogle's idea as a graduate student, is an index fund where you would literally own a sliver of every company, or representative sample of every company in the country? And
Yeah, so Jack Bogle's idea, so at Princeton, his senior thesis was the idea of an index fund. His idea, he essentially saw a paper similar to this one, the rate of return of everything. He's like, well, if you look at the average return of the entire index, it's like 10%. If you just took the fees off of that, that's a lot of money over 10 years. And just kind of going back on how people don't do big things anymore. It feels like, Jack Bogle, this is his senior thesis in college. I mean, think about that. That's pretty weird, isn't it? Like, he had the senior thesis idea and he's probably saved, given more money back to investors than anyone else. I mean, I can't imagine how many billions of dollars in value have been given to retirees and, all these pension funds that use Bogle's, Vanguard and just all the other index funds that have popped up afterwards.
You talk about good ideas. He didn't only come up with apparently he's largely responsible for index funds.
So he's large. So people had kind of done it before, but he popularized index fund investing.
And then the other thing I know him for is low fees, and saying if you could reduce management fees, your yield, the amount of money you made would just over time would be much, much greater.
Yeah. So standard investment funds usually charge 2 and 20. That means 2% of the amount you have invested every year, and then 20% of the returns. And so you'd have to outperform the index so brilliantly to make money after 2 and 20 that it's just really not possible. There's a couple people that can do it, they in weird ways, but they have secrets, and it's not something you can really replicate.
That's one of those things that in that random walk theory is that the market is random and you can't select the winners, and all that stuff sort of in vain. I mean, that's the idea in any event.
So that's more, so the Eugene Fama, the efficient market hypothesis. It's the idea. So, if you got 100 people and they're all measuring the number of M&Ms in a jar, the average is really close to the number. It's very similar. Like if all of the information is public and we all can see that information and everyone is rational, the price will be just about what it should be. Now, big asterisks here. So if we all see the public financials for Apple and we all make our own decision, like on average, like the price that Apple is fairly efficient. So why do you get this equity premium then? So you get this equity risk premium because it's volatile. So people, they need money in the short term. So they're not willing to always invest it in more volatile assets like equities because they need to spend it tomorrow. That's one thing. The other way you can make money is inside information. So that's illegal, right? But, if you knew there was special information, if you were a lot smarter than everyone else and everyone missed something, that's another way. Or, so some people can make money beating the market. And there's people that, there has to be someone to make the market right to make it efficient. So all the people, there's like a lot of professional people who spend. So if you spent like all your time and you're super smart, you could probably beat the market, but you will also probably, like it's efficient in that it'll kind of just pay for the time you spent doing it. Does that make sense? It's hard to just like critically evaluate other than it being just random and get a higher return, if that makes sense.
So it's really hard to it's hard to do anything other than get the market average, which you've got a very reasonable chance to do if you bought
Minus
the entire
fees.
market.
Yeah, you do have a much more reasonable chance. And the important thing to remember is like it's super competitive to price it correctly, right? So you've got like all these smart people who have this financial incentive to be correct, and that's what you're going up against. And like you have to be like really good to beat that, and that's what most people miss.
Yeah. So that's very difficult, but trying to get the market average is
straightforward.
Fairly straightforward.
Yeah. So you're just counting on the equity risk premium, and that's much, especially over the long term, it's a much easier strategy to follow.
And that's what Bogle has sort of brought to Main Street, is that you can do that with the index funds, and you can get low fees by cutting out a lot of the management and
right.
doing indexes. You do those two things, and then Main Street can have stocks.
That's right.
That's right. Equities.
That's right.
And we've talked about this, at least as on an aside, is like there might be two reasons that the stock market is where it is even today during the pandemic, and it's bounced back significantly.
That's right.
One of them is money pressure, which I think of as like water pressure. The money's got to go somewhere to be invested.
It has to go somewhere. Yep.
And I don't know if we haven't gone much to bonds and bills yet, but they have very low yields because interest rates are low.
Yeah. So historically, like, do you have the paper pulled up by any chance?
Don't.
Do you have what the rate of return for bills and bonds has been on average?
I don't. Not at my fingertips.
Okay, talk for a second. I'll pull it up.
Okay. Then what I will say is that because rates of return have been low at banks, then that tends to cause pressure to put money elsewhere, and because housing is much more difficult to invest in, that puts more money pressure on the market, which tends to prop it up during bad times. And I think the other thing is that Bogle made Main Street aware that by holding and realizing the market goes up and down, that you would be able to do well in the long term. So Main Street's not prone to sell off things, and Main Street holds a lot now. Individual investors hold a lot of the stock market.
Yeah, especially 401ks, you're like incentivized not to sell, and you pay penalties and to withdraw. So I did find the average unweighted returns for bonds are in real terms are 2.6%.
And what's inflation these days?
Well, that's real returns. That's adjusted.
That's real returns.
Now compared to what's the real return for bonds now? It's less than that.
It's probably less than that.
Because they would have to return 4% right now you'd struggle to get a bond that returns that over time.
And then you got to pay taxes on the gain.
Yeah, then you have transaction fees on top.
And transaction fees.
Yep.
So it does create a lot of money pressure on the stock market.
Yeah, searching for returns.
Yep.
Yep.
So that explains a lot about. And one of the things I say is that one of the riskiest places long term to put your money's in the bank. Everybody runs to the bank. Your grandmother was like this. Your grandfather was like this. And their generation was like this because they lived through the Depression. So they put their money in the bank because it was safe. Well, that was true in a sense, especially with FDIC and the Fed and all that stuff. But over long term, inflation and taxes chipped away at it.
That's right. Yeah, you're losing 2% a year on inflation, and and what did the banks do with it for your savings accounts? They put it in T-bills, so they borrow it from the federal government, and then they take some cut, and then they give you that percentage. So
right. So that's one of the riskier investments long term. Whereas if you get in the stock market and you hold through the ups and the downs, and some point in the future, you may elect to take some of it out.
Well, yeah. So, yeah, it does come back to it's like, what do you mean by risk? Do you mean volatility? Do you mean how much does it go up and down? So, for example, houses, like they seem like really low volatility, right? Because you buy it and then you don't know what price it is. In reality, houses probably have similar volatility to equities. Just judging on the returns, they probably have similar volatility. It's just like you don't have this ticker like paying.
You don't know
Constantly, yeah.
You don't have it pinging away, and on the nightly news, they never go. And your housing value today, it went down $5,000.
Handle down. It went handle down today. 5% down. Oh my God. Yeah, no, you never hear that, which is different.
Okay. So we've unpacked a lot of this, and
Yeah.
Would you like to summarize some of your thoughts about the rate of return of everything and what you think it means?
Yeah. So I think the big takeaway from the rate of return of everything was kind of confirming my biases a little bit about equities being, especially for someone like me, a younger person, that's the place you want to go. That's the place you want to be thinking about if you if volatility does not bother you. So if you don't, if it dropped in half, like if that doesn't bother you, a lot of people psychologically, investing is mostly a psychological game, and whether you can handle losses. And a lot of people have a lot of trouble with that. I think it's inbuilt to human nature. Most people would much rather avoid losing than winning. I think that's it's the truth about human nature that's important to keep in mind, and important to keep in mind about yourself in investing. Equities, it's interesting. The most surprising thing to me in the paper was real estate actually outperforming equities. That was, I did not expect that.
I agree about that, and they're very similar. There might be a small edge to housing, but it's not very large. And one of the points I should make, and probably is people are familiar with this and some may not be, is that you've never lost anything in the stock market until you sell it. Yeah. So if the stock market, and it has during my lifetime, it's gone down half.
Yeah,
and it will get your attention when it does that, but it also lets you know that the one thing you can't do is realize your loss. You can't sell then.
Yeah. Well, it is important to remember though. So if you buy a basket of equities, like you'll tend to get something, maybe you'll get something similar to the returns. I think returns will be lower just because interest rates are lower. That's so important to keep in mind. Lower than what, is stated in the paper, which is 10 some odd percent. I think they'll be much lower than that. I think equities will still remain higher than bonds and bills for the foreseeable future, just due to the current interest rate environment. And that seems to be like a solid trend you could count on. Knock on microphone stand. But that's just something to keep in mind is you never want to invest more than you can afford to lose and what you would need in the short run, because in the short run, lots of crazy things can happen.
I think that's a couple of things about that I agree with is if you're in equities, you're in for the long run.
Yes, that's important to remember.
The entire paper is about the long run, and that's what we're talking about. So you don't buy a house and sell it next week or next month or even next year. Everybody would know that would be a risky proposition. And I wouldn't be willing to go into the stock market with that kind of time frame either, that time window. So going in when you're young and having plenty of time to learn and study and observe and watch your money grow seems to be really key. And one of the things I really encourage young people to do is because you need that long time window, the long run.
Yeah, time matters more than almost anything else. Time, fees matter more than anything else. And so we talked about one more thing. We talked about returns, and this is the raw returns, real returns. That does not include fees. And I encourage everyone to go out there and just look at your 401k and see the fees. I remember, there's a formula you can use. We won't talk about it today to calculate expected returns based on the dividend yield and a couple other things. Jack Bogle used it. I think it's a useful tool. I wouldn't use it for its predictive power, but I think it's good to think about. I think right now, like 401k that I use has fees that are equivalent to probably a quarter of the returns, expected returns year over year, right? And that's pretty standard in the industry, and that is a massive amount. I want people to understand 1% of fees is huge.
Yes.
It's huge because if you're only getting, let's say you get, nowadays 6% real, 4% real returns, say 4%, that's a quarter of your returns, which, it's a lot of money.
It's a lot of money. And, people often spend more time mowing their grass during the week than they do reviewing their retirement portfolio or their financial situation. And it doesn't take a lot of time. And you certainly don't have to be a rocket scientist or brain surgeon.
Yeah.
I think that one of the beauties that Bogle and Vanguard brought, and we've mentioned them several times, and it's because it's easy to understand and very helpful. One of the beauties of what they've recommended is it's something that you can understand. It's something you can appreciate. It's something you can be involved with and take advantage of. And that's what they brought to Main Street in America.
Yeah, I think it's quite good. It's a very elegant idea. It's like, what if you could capture the returns in this paper? Like, that's all we want to do. Like, and he wrote a book right before he died called Enough. I love this book. It's called Enough. He's like, well, Jack Bogle, he's pretty wealthy person by the time he died. He was like worth probably $80 million. Like, he's like, I've flown in first class and it was nice, but it's not that much, 10% returns, like that's enough. And it's a lot, it's going to make he's like, I've got $80 million. And, in terms of visionaries that captured a percentage of their value created, Bogle is way down there. Like, he didn't capture very much. So their big rivals, Fidelity, and for the Fidelity family, I can't remember the name of the owners, but they're all super wealthy, and that's always a sign, right? If you've got a super if your financial manager is really wealthy, you should be curious about that.
Yes.
You should keep your eyes open.
Because he got part of it by putting his hand in your pocket.
Yeah.
Somebody's pocket.
Exactly. And so that's how much the finance industry makes money or has made money in the past. People are much wiser now, but it's in selling securities and taking a rider. And like 2% of management fee sounds small, but in reality, you make a ton of money.
Even 1%. You mentioned
even
that.
1%.
So
even
large.
like these 401ks, 1% is huge and will really eat into your returns. This also reminds me, automated investment systems are better because removing the psychological and human element, like things that automatically invest, are much better than you having to think about it, because I think, it's easy to get rattled and have questions.
Yes. And, that's a good point about if you turn on the TV and you see some investment product, well, it ain't cheap to buy that TV time. So,
yes, you should always... Yeah, you should always be skeptical about people's investment advice, because generally, people have incentives to occlude and generally, like if someone's giving you investment advice on like what is the MSNBC business channel, you should be very skeptical, because unless it's Jack Bogle, because he's he created $1 trillion company. He's only worth $80 million. They manage $1 trillion. And he's only worth $80 million. He's a smart person. Well, that's telling you. He's giving that money to someone else, and that's.
Yeah, and for those interested in the podcast and in this subject, that's a great place to start reading. It's because of just what you said, is somebody that has that much under management, but realized, $80 million, anybody would love to have that, but when the comparison is
compared to like the other people in the field, it's nothing. And he, I would actually, even before I looked at Vanguard, I would look at Bogle's books.
Yeah, that's great advice.
Yep. Great.
Okay. Well, it's good to see you again. It's good to be here on the podcast. Thanks for joining us, and we'll see you next time on Narratives.
Thanks. Well, that's our show for today. I'm Will Jarvis.
And I'm Will's dad.
Join us next week for more narratives.